First of all, thanks the organizer for putting our paper to the program. We enjoy all the presentations so far. So this is a joint work with my colleague Imin at UConn and Manju Puri at Duke. The paper is about banks, VC investment in tech. This is the first time we present the paper. It's still very early stage, so any comments are very welcome. Unlike traditional VC, if you think about independent VC, banks VC investment usually have strategic motives. Manju have an earlier paper show that banks VC investment is try to build lending relationship after those startups become successful. If you think about example, which is Silicon Valley Bank. Unfortunately, this doesn't go well for them. Now, the banking industry recently has experienced a disruptive force, which is mainly due to the emergence of fintech competition. So a natural question is, has the strategic focus of bank VC investment also evolved? So here we make use of some mortgage lending data and try to compute the market share of fintech lending, meaning the mortgage origination by fintech lenders. In the past 15 years, as you can see, the market share goes from 0% back in 2008 to more than 15% in 2021. So in this paper, we hypothesize that venture investment in fintech startup could potentially be a solution for banks to deal with fintech challenges. There are a couple of reasons we think this is possible. First of all, this investment relationship can force technological collaboration or knowledge transfer between the two parties. Second, rather than engaging in direct competition, just talk to someone, say, let me be your boss. Let's figure out something together. So maybe this investment relationship can force business collaboration. Here's a data point in our data. Better.com is a fintech startup doing fintech mortgage, meaning originating mortgage online. And Ally Bank, on the other hand, also doing mortgage business. In other words, they're competing with each other in the mortgage segment. In February 2019, Ally Bank invested in Better.com in Series C. 2 months later, they collaborated with each other, where Better.com helped Ally Bank to create end-to-end digital mortgage experience. So in other words, now Ally Bank can do fintech lending as well. So this example roughly captures what we find in the paper. First of all, we do find bank venture investment in fintech are increasing rapidly. And in terms of the driving force, we do see banks are more likely to invest in fintech when they face high fintech competition. And in terms of which fintech they prefer, we find when a bank and a fintech have higher technological or business relatedness, they're more likely to form this relationship. And the most exciting finding in this paper is we find this investment actually result in strikingly higher likelihood of business collaboration. And we also find some evidence that banks' new patents filed after those investment relationships tend to cite fintech startups. I'm going to skip the literature for the interest of time. Here's the data. We're using Crunchbase to get the fintech startup and their financing information. So the sample period is from 2001 to the end of 2022. The bank sample is from core report using Honda data and bank branch data to compute fintech competition. One thing I want to emphasize is we hand collect data on business collaboration for more than 3,500 bank fintech pairs through company's website and Google News search. I know for this audience, 300 3,500, the tiny number. But I want to say this took us for a while. It's actually a very intensive manual collection process. How do we classify fintech? We classify startups into fintech and non-fintech mainly based on two variables in Crunchbase. They have an aggregate industry classification and a more granular level industry classification. Specifically, a startup is classified as fintech if the more granular level fintech, if the more granular level industry description contains the following keyword. It actually has a fintech industry, but we also include crowdfunding, cryptocurrency, virtual currencies, and so forth. We also make use of that aggregate industry classification if a firm operates in financial service, meanwhile also operate in AI or software, we also consider that firm as a fintech. So first, I'm going to show you guys some time trend. Here, we plot the number of banks make fintech investment, meaning invest in fintech startup, and invest in non-fintech startup. All the investments are VC deals. As you can see, the number of banks investing in fintech grew from less than 5 banks before 2011 to more than 24 banks in 2022. Percentage-wise, 20% of the banks making VC investment are investing in fintech. Back in 2001, now that percentage goes up to 70%. You may wonder, that's not surprising because now almost every startup are fintech startup. So we also plot this percentage for all investors, including VCs. You will see among all the investors making VC investment, only 7% invest in fintech back in 2001. Now that number still only reached to 34%. So since banks have an extra appetite for fintech startups, we find very similar picture from the perspective of number of financing round. The percentage of fintech deals invested by banks grow from 4% to 35% or more recently. That percentage doesn't grow as high if we become faster. In terms of number of fintech startups, by the time 2022, 51 banks have invested in 323 unique fintech firms. This is what we have in data. So the first question we want to ask, what drives banks to invest in fintech? And which fintech they prefer? So to do so, we structure empirical specification where we first classify the 511 bank fintech deals as our treatment group. For each treatment group deal, we create 10 pseudo deals because we want to see why bank A pick startup A instead of B. So we create 10 pseudo deals by matching the actual bank with 5 other banks that don't make investment. With other 5 pseudo investees, which they don't have an actual investment relationship. We want to see why they don't match with each other. Similarly, we match the actual fintech investee with 5 pseudo investors. So the candidates for pseudo investees are also fintech firms and also receive VC round during the same year, but not from banks. The candidates for banks, the candidates for pseudo investors are banks that do not make investment in fintech in that same year. So we use them to see why they do not make a fintech investment. We construct 2 control samples, follow the method of Ben and Lee GF paper. We first randomly select 5 fintech to create 5 pseudo investees from our pool of fintech candidates. We also randomly select 5 banks, create 5 pseudo investors to match their actual deal. Second, we try to select things based on propensity score matching, try to make some efforts in order to select fintechs have similar size or similar performance. we use firm age and size of the financing block. We also try to select similar banks by selecting banks with similar size and the book to market ratio. We call this sample as percentage score matching potential sample. So the first thing we want to look at is fintech competition and the bank's investment in fintech. To do so, we have to come up with a fintech measure. It's easy to come up with a measure that have time series variation. It's actually hard to come up with a measure that's specific to a bank because in any given year, some banks make fintech investment, some do not. So to overcome this challenge, we measure fintech competition with the growth rate of the market share of fintech mortgage lending. Why using mortgage data? First of all, mortgage lending is the core business for banks. Second, this segment, we have rich data. So our goal is to construct bank-specific fintech exposure or fintech competition pressure. So to do so, we first compute the growth rate of mortgage loans originated by fintech lenders in a given county and a year. We then compute the average growth rate of the market share of fintech lenders across counties, weighted by the number of branches a bank has in that county. So now with this aggregation, we're able to have a bank-specific exposure to fintech competition. Here are some summary statistics. The sample here is 511 actual deals, and the 5 pseudo deals where the fintech are the actual fintech, the banks are pseudo banks. You can see in the actual deals, the banks on average experience 24% growth rate of mortgage lending, fintech mortgage lending. The random sample and the propensity score matching sample, that growth rate is also high, but around 20%. If you look at other characteristics, banks actually make fintech investment are quite innovative. On average, they produce 26 patents a year. On the other hand, these two are almost minimal. So the univariate tests tell us large and more innovative, profitable banks tend to make investment in fintech. If we use the same sample and put those into a regression setting, this allows us to control a pair fixed effect, meaning we can compare the one actual deal with the 5 pseudo deals. Within that 6 deals, why the bank doesn't make investment in fintech the pseudo bank. As you can see, fintech competition is very significant both statistically and economically. In other words, for example, one standard deviation in fintech competition will drive up the investment likelihood by 12%. The unconditional mean is 9%. In other words, this basically double likelihood. The next part, we also want to look at the pairwise characteristics. Why these banks match with that fintech? We look at the technological relatedness and business relatedness. Technological relatedness are built on patents. The first measure is quasi similarity among the patents filed by these two parties. The second set is cross-citation. Do they cross-cite each other or which direction to go? For all these variables, we're only using patents filed before the investment relation. We also look at overlap business because they report which industry segment they operate. We count the number of same industry, or we also compute the percentage of same industry. Here's the regression analysis. Now here, the sample is one actual deal with 10 pseudo deals. We basically include further 5 pseudo deals where fintechs are pseudo fintech, banks are actual one. Technological overlap seems to play a role. If we do cross-citation also play a role. And more interestingly, it's actually cross-citation by fintech. They seem to try to attract banks' attention or generate that new technology actually build on a bank's technology. One example I observed in the data is For example, Square, their patents, they cite Visa's earlier patents. Because if you think about Visa, they have a cool technology back on to facilitate payments. We also observe very similar results using overlapping business. So since the banks care about their business operation. Now, the most exciting part about the paper is why banks make this such investment? How do banks benefit from this investment? To do so, for each actual deal and pseudo deals, we hand collect information on their business collaboration, if there any. Okay? And once we find a business collaboration, we read the description and classify the partnership into 3 types. The first one is we call it utilizing fintech technology. Okay, if the collaboration is a bank utilizing or incorporate fintech firm's technology, then we call it utilizing fintech technology, which is the example I showed earlier on. We also see other type of partnership. For example, cross-sell to bank customers. Once we have this partnership, fintech are actually able to sell their product to bank customers, or the other way around, cross-sell to fintech customers. Here are some examples. I'm going to skip those in the interest of time. This is summary statistics. Here you may notice the number of actual deals goes from 511 to 328, because now we only look at the first time the pair meet with each other. If a bank make multiple investments in the same fintech, in the selection model, we include all of them. Now here, we only include the first one. On average, 31% of those pairs form business partnership. We actually collect all available partnerships. Less than 2% of them, they form partnership before the investment relationship. 31% of them form post the investment relationship. Around 16% of them involving utilizing fintech technology. 10% of them involving cross-sell to bank customer, and 8% of them involving cross-sell to fintech customer. If we do the same thing for control group, those are pseudo pairs. They don't have actual investment relationship. We find only less than 2% of them having business relationship. Before we collect the data, this is not what we expect, right? If you think about it, banks can make business relationship without making investment. I can directly collaborate with you. Why would I have to make an investment? But once we collect the data, seems the investment relationship matters a lot. If we want to put that into a more rigorous regression setting, or if we try to control selection effect, because we do document selection effect, we come up with an IV analysis. As I said, this is the first time I present. IV is never perfect. So any suggestion will be extremely welcome. Here, we using the bank's local market share in the VC space of that fintech startup to instrument bank's fintech investment. The argument here is if bank have a large local market share, this basically represents the ability for providing fundings in the local market. This will positively predict the investment relationship. On the other hand, the general funding availability do not affect the probability of collaborating with each other. We put that into an IV two-stage listed square. We find, first of all, first stage is quite relevant. Second stage, we do see actual investment relationship foster business partnership, especially in those partnerships utilizing fintech technology or cross-sell to bank customers. We do the same regression by looking at cross-citation. The 3 cross-citation measure, the only one significant is the cross-citation by bank. Here we switched. After investment relationship, banks' new pattern tend to cite fintech's pattern. It's not the other way around. We find this quite interesting, but we present this with caution because the significance is not that large. All right, let me wrap up. So in this paper, we document a rapid increase in trend over the last 20 years that banks have more high interest in investing fintech startups. And we think banks' VC investment continue to be strategic, but in a different way. And banks are more likely to invest in fintech when they face high competition, when there's synergy going on, and VC investment actually result in a very high likelihood of operational collaboration. That's pretty much about the paper. Very much looking forward to Zhiguo's discussion.
The existence of this paper almost 2 years ago. So these guys did a fantastic job. Now I see the final product. Even though that the paper is only 26 pages, so which means that probably this is a very early stage work, and it's also making me easy to read but hard to comment. But the title makes me very excited, from competitors to partners, right? Venture investment in fintech. It's also that initially I thought that these guys can talk about these vertical integration stuff they do, blah blah blah. It's hard, right? It's this is the holy grail. And they did the first step, and I do learn quite a bit from simple steps of this. Okay, so why this is a topic that I am really interested in, and also try to do something. And this is because partly fintech disruption is cool. Everybody understand that, and this is why we gather here. But I don't think banks will be replaced. And it will be never. Okay. It's cool, but never. First of all, lobbying tighter regulation on fintechs, we see that, and it is a good thing. It's also could be bad, but it's just that it's there, and we understand why, and stuff from the very long time ago, all the time even before all these things. Right? The second thing that is what I did, I have a working paper with my colleagues at University of Florida, Warrington School. We document the heavy and rising investment in bank IT for the banks, and we use existing data source. You probably know all these. Their own small group paper we're highlighting the man versus machine. So we basically took their data and focusing on zooming the banking industry and do the work. Okay, but this is not the I guess this is why that I come here. I am here to discuss this paper. The third thing, which is acquiring fintech startups, is this paper about, and I do think this is super relevant. Okay, the key results and the takeaways are three things. Xiang talk about the three things in a pretty sparse way. I think it's very useful to condense them and then tell you what they deliver after the careful and the very, very significant data work. First of all, banks invest in fintech when facing more intense competition from fintech. All these things are just claim, right? Claim, sometimes they have a gap between claim and data empirical facts, but at least this is their message try to deliver. So investing in fintech when they face more competition. Second, banks target fintech firms that exhibit higher complementarities with their core businesses. Okay. The third one is bank investment. In fact, in fintech, more future operational collaboration. Now, all these things, seems all make sense. One thing that I heard that I was listening carefully at Xiang's presentation. He was saying that the bank investment in fintech was surprising. This result was surprising. To me, it's not surprising. Basically, that they find that after the investment, then they see more collaboration. Okay? That's time seriously. You have this first did this, then second. Let's just not to talk about this causality issue. Okay, that's a secondary. I think that this is very obvious, just because that once we have common share equity, so it's much easier to talk about, much easier to negotiate. right? This is to me, but it is still very important fact. If you see opposite, then I would say, oh, why? That kind of question. Okay, so my plan is that, obviously you have all these issues of identification. I'm not talking about it. I'm not placement on this kind of issues. I do want to kind of make two suggestions because I'm working on this area. When we working on the bank IT investment paper, we tried very hard to, mugging around, try to see whether there are some cross-sectional plausible exogenous variation you can explore. The first one was the country level refinancing demand exposure that we show that it is correlate is driving this refinancing demand basically. So this is a refinancing demand utilizing the existing instrument variable, which is take advantage of the fact that there's some huge cross-county heterogeneity in the refinancing savings due to the low interest rate environment around 2015. So from 2014 to 2017, there's a huge amount of rate reduction, and then a lot of mortgage papers. I'm not an expert, but I know that yesterday Gregor was here, so they basically calculate. This is fantastic data for the home down. Like they know everybody's mortgage, right? As a result, they can calculate in 2015 one rate cuts, how much money they can save if you refinance, and then a huge. Of course, it depends on when do you get into the contract. Will have cross-sectional differences in the refinancing demand. And this is the why, exactly in the GSU paper, saying that, then fintech guys come in, blah, blah, blah. Why this is it useful? Now, it's not really just to drive home the total exogenous. You see the common demand shifter. However, that's at least the variation coming from. And then you can discuss a lot of things that are, what bank does do, right? So instead of now, you're basically saying, taking the fintech competition, facing the competition as the exogenous variable. That's just, I think much better the source of the variation. Second one is that we were using the land grant colleges, which was determined in 1862. I never know this thing, but my authors knew. This is also used in the literature, affect the skilled labor supply in local area, and you might want. Okay. Mainly that in today's discussion, I will do two things: comment on imperial facts in this paper that are useful for researchers, especially for theorists that shape my mind, that in thinking about these issues. Then the second that actually I did have a project. I don't think the Baozhong, when you invited me, you didn't know. On the exactly same topic, but this is with Zheng and Vincent. But using PitchBook, I think it's better data set. But and now today, I realize that it's just I should have stopped. We're using bag of words, and wow, I never knew this word before. Bag of words, so that's bad. So I will stop. I will stop. We're working on this project. You guys, should move on. And I really think a pitch should be better. But I will mention some things I learned during this project so that maybe it's good. So first of all, that I learned quite a bit by reading these examples. They have three different kind of collaborations. I thought this is a fantastic idea to really dig deeper. So fintech bank partnership utilize fintech technology. That's kind of what we knew. So this is about a fraud prevention. It's interesting. The second one is this cross-sell to bank customers. So here's American Express offered its card member statement credits. I initially didn't know what does that mean, statement credits. Basically, that if you spend $5,000, now you only need to pay $3,000 in that month. Okay. If they originated refinance conforming mortgage loans through better.com. So that's clever. I think this must be, because they invested together. And then the second one, the cross-sell to fintech customers. This is the cross-sell to the the American Express customers. This is to the fintech customers, and then this is like draft the initiative campaign to bring savings accounts to 1 million students in minority communities. Okay. Anyway, those things that I feel like okay, interesting. This is what they do, and if you want to like models or the things that they use. The second one, I also feel wow, okay, this is changing my perspective a little bit. Is the fact that the bank investing in very late stage fintechs. We kind of knew the paper of this killer innovation. Is that right? That's pretty influential paper. Soma and last name I forgot it exactly from Yale. It's like acquire these new startups and then kill them. I'm not sure this is what they want to do if they just investing in very, very big ones, the later stage, right? It's way more positive than the picture painted by the previous researcher, or at least in the bank is not. So then you might think about it, why do they want to do it? And then clearly they wanted to collaborate. Okay. This is another thing is that you guys have do not read the description. Bank lending seems to very, very broad. I'm surprised that only 20%. I just do not know because partly that this is what we did. So we developed so this is move on to the saying that what I did. It's in the pitch book. So we developed a rich dictionary, the bag of words still. On 3 categories that capture a fintech. So what we at that moment, we wanted to not only understand how do they put it together. I want to know what these fintechs do so that the bank are interested. So we say that okay, they might provide a different kind of services. So we have a 3-dimensional thing, and then they might use technologies. So they're pushing for the technologies, and then what kind of customers they're serving. So we did a lot of work on these bag of words stuff. Now it's outdated, but still I learned something from that. Then these fintech services, all these stuff. It's just that not try to tell you anything about it. Just to tell you that it's something I learned from it. Is that PitchBook is the last slide. PitchBook is better coverage and high quality. It's more expensive, obviously, and maybe that's why you guys don't use it. So yesterday we were chatting about the Crunchbase. Well, these guys have 2775 fintech deals, and then you said that it's a US based. Maybe that's the difference, because clearly that PitchBook is international coverage. I forgot how much that we had because long time ago. But Barbina, Greg Buchak, and the 7 authors now, their paper. They document about the 30K from these things, from these periods, and they might not try very hard to include all the possible fintech because they have different needs. And if you can, I was trying to convince you that the PitchBook is better, and I think it's better to ask ChatGPT if you recognize the font. That's ChatGPT font. Professional in finance and investment. Blah, 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 blah. Okay, but careful on textual analysis. At that time, that this is what does effect lending description mean? I do not even know. To be honest, I do know that many software companies it's just a very catch-all word for banking as a service. I do know that the notice when I read it or there, so be careful. And another important thing I wanted to mention. There's another big category. I do not know whether you captured it. Zeller. So Zeller is a best example, extremely successful. It's a fintech startup, a consortium of group of commercial banks. Those things are, I think, it will change our life way more than other things. And these guys basically, about 12 years ago. They created something called a Clear Exchange Service. The predecessor of the Zeller was launched. It was originally owned and operated by it. So those are the things that I do think that I do think it's captured by what you algorithm, but I think this is the important part that if you go back to the original title. I think, the color will be very different if you realize this is something about the within bank collaborator on fintech thing on this question. Okay.